Today, we jumped into how you helped a couple who was making $1.2 million write off a significant chunk of that income. We also talked
Mhm,
about how, as an individual without $1 million income, write
mhm.
off or make $1 million and not pay any taxes on it. And then,
Yeah,
of course, we go into some hot takes of all the things, the new administration or what's going on social media,
mhm,
Derek's hot takes on how that could all get impacted. Again, my name is
mhm.
Josh Baldovino. I'm one of Derek's clients and a real estate investor. This is Derek Fujikawa, who's the
Right?
managing partner of Fujikawa and Associates, and this is Office Hours. Let's jump in. All right, Derek, it is February 5th. Everyone should be getting some of their tax documents, so it's
Mhm.
almost crazy for you.
It's getting there. Yeah.
And so, as we talk about today, we're going to go into some of the current events now that we have a new president. What are the
Mhm.
rumors? What are your quick thoughts on some of these things that he said or
Sure.
tweeted? How it
Mhm,
might play into your strategy? And then you
mhm,
have a couple of really interesting case studies for
mhm.
real estate investors that you worked through last year. And then we'll play a little game at the very end. So let's dive right into it. I just want some current
Sure.
events. And for me, I think the
Mhm.
biggest thing that happened this past weekend was the impact of new tariffs. So, Derek, real quick, what
Sure.
is a tariff and why does that affect businesses?
So a tariff is something so if the US imposes a tariff on a foreign country, it's basically a fee that they charge on an imported good. And so whoever buys that imported good from the foreign country is going to pay this tariff. So it just basically increases the cost of that product.
Quick clarification. So then that means it's not necessarily you put a tariff on goods from China. It's not the
Mhm.
Chinese companies who are importing them into the US who are paying it. It's the US then buyer who's paying a tariff on top of that when it gets to the port or
Yes.
wherever.
Yes, correct.
Okay.
Correct.
And so then how does that impact the businesses and then
Mhm.
eventually everybody else?
So there's no tax implication per se because it doesn't affect the tax code. There's no US tax code ramification. But for small businesses or any type of business, that just increases their costs, right? So either one of two things are going to happen. Either their profit margin is going to shrink because their costs are going up, or the end seller of the product is going to have to raise their prices to recoup their cost and keep their margins similar or at least somewhat profitable. And so that just ends up creating a higher cost of any product that, and any end product that uses those imported goods.
Okay, so everything on Amazon will jump up 20% now.
Yeah.
All right, so if you're an Amazon seller, I guess you're in the e-com space, you're probably looking at this really closely then.
Yeah, most likely. Yeah. Because you're going to have to determine if you have to raise your prices and see what your profit margins are going to be after these higher prices.
All right, the next rumor, again, these are all hot takes of what we think could happen and how it can impact you. The proposed no income tax.
Mhm.
Ultimately, do you think is that good or is that bad?
It would be good, I guess, for everybody that doesn't have to pay income taxes. But this has been proposed a number of times. I've been a CPA for almost 30 years and I've seen it come and go number of times where they propose no income taxes or flat tax or something to eliminate the tax code. And it never gets very far. There's too many special interests involved in the current tax code itself to be able to just throw it all away. I usually don't worry too much about it until it progresses beyond just the rumor mill.
So ultimately, us, which majority of you who are listening to this are probably in
Mhm.
California somewhere, or
Mhm.
probably a high earner. That
Mhm.
hope of avoiding those income taxes at the federal level is very slim to none.
Correct. And California, if you're in California, California doesn't necessarily always conform to the federal government. So if the federal government got rid of their income taxes, California probably, or I would can almost say definitely, I can't say definitely, but almost say definitely would not get rid of the California tax structure. So you'd still have to file a tax return.
Okay, so we're moving to Texas.
Sure.
Corporate tax, no corporate taxes. I guess on the
Mhm.
opposite side of the spectrum, it's not the
Mhm.
individual, it's the business getting cut. What do you think happens there?
That could happen. And so, yeah, if it goes down to 15%, it's currently at 21%, but if it goes down to 15%, creates a little, not confusion, but a little more options for business
Mhm,
owners. Because the whole thing before was with if you're, say, a small business and you want to become a C corporation, the only way to get the money out is to pay yourself a wage or a dividend.
mhm.
And either way, paying yourself a wage is ordinary income, paying yourself a dividend gets double taxed because dividends aren't deductible by corporations. So you're getting taxed at the corporate level and then taxed again at the individual level. But if the corporate rates go down to say 15%, then you're paying 15% on the corporate side. And then if you pay a qualified dividend out of your corporation, you're only paying potentially 15% on your individual side, then that could be less than the higher individual tax rates. So it is going to take a little bit of planning and kind of crunching numbers to see which way might work out. In a lot of cases, an S corp is the way to go if you're thinking of incorporating a small business. But With a lower corporate tax rate, the C corp may be an option. Again, you'd have to run the numbers and see, but it's potentially an option. Now, before it was a no-brainer. You don't want to go C corp because you're going to get double taxed, but there could be some merit to it if that changes.
Okay, so if 2025 is the year where you're thinking about opening a business, have a conversation with Derek whether you want to go
Mhm,
LLC, S corp, or C corp to make sure
mhm,
that depending on where you are in the year, things might
mhm.
change, which then change how you might incorporate.
Sure.
Okay, this one's fun. This one at the conference got a lot of questions. No tax
Yep.
on overtime, no tax on tips. I am a
Yeah. So
lucky
those.
job at a high-end restaurant.
So I've heard those. All the campaign promises and everything like that. That'd be great, but I don't know how they would implement that. And if they do, it's probably going to be an administrative nightmare for a lot of business owners because you're going to have to track all those tips. It's going to be a lot more paperwork and figuring out how to handle the withholdings and everything on those, because normally overtime is just regular wages, so you just add it and you pay the withholding. So it's going to be a lot more administrative work on the business side.
And then
I
obviously
don't.
everyone's very incentivized to then try and find some way to finagle it into some type of overtime or tip structure. Obviously,
Yes.
for the real estate conference, the big thing was, does my real estate commissions, can my referral fees, if that eventually goes that way, could they
Mhm.
eventually be paid out in that way? I guess just for a general sense, how are commissions and referral fees taxed currently today?
It's just ordinary income. So if you're a
Okay.
small business, it just gets added to your regular income. So there's no special rate or anything like that for commissions or referral fees.
If this, say, ever got passed, what magic wand would have to happen for me to sell this house in San Jose for 1.5 million, get my 2% commission, and have a large majority of it be a tip?
If it were to get passed, I think for the first couple of years, there's going to be a lot of people testing the system, I bet. So there's going to be just tons of people doing crazy stuff, trying to make everything a tip. And then the IRS will take a couple of years to figure it all out and then start writing regs and things like that, regulations to define what a tip is. My guess is that anything that was not traditionally a tip, you can't just turn around and now say it's a tip. But again, I don't know. Maybe you can get away with it for the first couple of years until they actually narrow down the scope of the law or something like that. But that's all speculation. Who
Yeah,
knows? Even if it gets passed or not. But
I know how. I got it. I got it right here. Much like at a restaurant, when you
mhm.
seat your party of 6 or more and you have to pay your forced 20% tip, now on the end of the real estate transaction, I turn the iPad around and you now have to put in your tip and it starts at 20% of whatever. You want to give me a 2% or a
Yeah,
3%?
I've thought about it. So say, what if I just cut my fee in half and say, oh, just tip me the other half? Like I said, I'm sure there's going to be a lot of people trying to be super aggressive with it, and then it's going to take the IRS
Catch up.
to catch up and yeah, create more specific guidelines for it. And who knows how long that will take if they're cutting IRS staff. So I don't know. Interesting times.
That is the perfect softball to my next one, which is they are cutting IRS staff, which I mean, I guess doesn't help the situation if they're trying to make a bunch of changes and then also cut
Mhm.
staff. Way harder to keep up with it all, right? I would imagine, just from a volume standpoint.
Yes, it does. Their systems are pretty antiquated, so it's not like, oh, we'll just use AI to supplement. Their systems probably aren't even set up to handle a lot of those types of things. So I don't know. Like I said, it's going to be an interesting time to see. I mean, might have to kind of reverse on that if things get way out of hand.
Okay. This one, out of left field, since you mentioned AI, there's a bunch of AIs out there right now. You get your
Mhm,
ChatGPT, your Claude, your whatever.
mhm,
From just a accounting and numbers perspective, do you have
mhm.
a favorite one that like helps you at all in your business?
I use ChatGPT for certain things. There's actually some tax specific ones now that have come out. So I've actually subscribed to one called Tax GPT. They actually focus on going through all the tax laws and everything relating to tax. So I use that for a lot of my research on top of the traditional research. But just general inquiries, I mostly use ChatGPT.
Okay. And then this one I did get a question with on Instagram when I posted that. The mortgage loan interest and your ability to deduct that change at all. What are your thoughts on that? And I guess what's the current state for homeowners right now as it
Okay.
changes?
So currently you can deduct mortgage interest on $750,000 of principal on your primary and a secondary home combined. So if you
Mm,
have two homes and their mortgages add up to 750 or less, you can deduct all the mortgage interest, or one
only two.
home, one up to two. So one or two as on the schedule A. So if you have other rental properties, those can be deducted elsewhere, but as just personal properties, you
Mm.
can deduct up to 2. And so that was under the Tax Cuts and Jobs Act, which is set to expire after this year. So if nothing happens, if they don't pass anything, it's going to go back to the way the law was before the Tax Cuts and Jobs Act, which would be $1 million of principal, and you also get $100,000 of equity principal that you can deduct the interest on. So it actually jumps up to 1.1 million. And so the 1 million has to be secured by your home or the one of the 2 homes that you're using as your base. And then the $100,000 can be used for anything. That equity loan could be for a car or whatever. So that's how it was prior to the Tax Cuts and Jobs Act back in 2017. But with the new administration and the Republican Congress, there's probably going to be a new tax, either an extension of the existing law or more likely either an extension plus modifications or a whole new tax law coming in. So we'll see. But as it stands right now, it's set to expire at the end of this year.
Okay. And then this one was interesting and surprising because you have Trump comes in, Elon is now his best friend, Tesla stocks go to the moon, but
Mhm.
EV tax credit could get cut.
Yes.
Thoughts on that?
Yeah, that was an interesting one. Most people know Trump's position on climate change and things like that, but I thought that maybe with Elon being part of his team that he would want, that he would want that EV tax credit to continue. Because I mean, obviously that helps. Okay, this is somewhat speculation. I don't know for sure if this is the case.
Love it.
My thought is, okay, if he gets rid of the EV tax credit, Tesla is so big, right? It controls the market basically on EVs. There's all these little companies coming up that are relying on the tax credit. So if you dump the tax credit, it's going to really hurt those. It'll hurt Tesla, but it'll hurt those companies more. So would that thin out the competition for Tesla?
Yeah.
So I don't know. So maybe the dark reason behind possibly getting rid of that.
Because that gives you an extra $7,000 swing to pick whatever you want.
Yeah. But so you have until the end of this year as part of the Tax Cuts and Jobs Act. So at the end of this year, if it goes away, then you won't get that credit. So if you're thinking about an EV, this is your year to buy it. Same thing with like solar and things like that.
Totally. And not a plug. You can
Yeah.
drop in your referral link if you want, though, Derek, for Tesla to get your lifetime supercharger. But past year's Model Ys come with a refresh. Those are now like on sale. And if you can get the little lax bits for the
Yeah.
go. Last thing, any other changes that like are on the back of your mind as you're looking at? And now I'm sure you're talking to a bunch of your clients in terms of 2025 planning.
Yeah, I mean, some of the education credits might go away and the student loan interest. Although in this area, if you have 2 spouses that work, you're probably phased out of a lot of those things already. So it may not affect you too much. If you do rely on some of those credits, they may be going away after this year.
Okay.
So
So Silicon Valley always gets a little bit tough, but Boothor, I
yeah.
guess you have tech salaries, so it's not that tough. Okay, let's go into some interesting case studies. The best one, and I think there's 2 different cases we want to dive
Mhm.
into. You have a
Yep.
client with an interesting STR loophole, or at
Mhm.
least said the amount was significant. Was that the one?
Yes, yes.
All right, so just quick hook. How much do they generate on this STR loophole?
So they saved almost $200,000 in taxes.
Wow. Okay. And that's 200K that they could write off on whatever year they did that in, right? Okay. So someone's looking and they're, some PM at some tech company making 300. They want to write off 200. How the heck do they do that? Because that is almost 3 times more than we got.
So it's a couple,
Okay.
and they make over $1 million between the 2 of them in W-2 income.
Okay.
So you've got roughly 1.2 million. So if they were to just file the return, say they bought a rental property, it's a passive activity, you can't deduct the losses. They would have owed somewhere in the neighborhood about 250K on the federal taxes. So they bought a $3 million property as a short-term rental in Hawaii.
So like a big, giant, gorgeous house.
If you're not familiar with the short-term rental loophole, if you rent a property for on an average of 7 days or less, and you materially participate in that property, it could be converted to an active trade or business, which would allow you to deduct losses on that short-term rental. They kept good records. They qualified for this provision. And so they did a cost segregation on a $3 million property.
And what year was this? Was this last year or?
No, it was a couple years ago.
Okay.
So you do a cost segregation, even 15% or even say 20% of $3 million is $600,000.
Yeah.
Right. So that's a deduction you can take in the current year on that property on top of all your regular expenses and everything to get it set up. So they had a very significant loss on their rental property, on the short-term rental. And so that on top of all their other expenses created almost $1 million loss. So
you almost wiped out their entire.
yes. So yes and no. Yes, the numbers offset each other. There is a limitation to losses
Okay.
that you can take. So business losses that you can take in 1 year. So it ends up being roughly about $500,000, a little over 500,000. So they were able to take that $500,000 loss against their $1.2 million wage income, and that generated about $200,000 of tax savings.
Okay.
So and then the remaining gets carried over to the next year and the next year until it's used up. But you're maxed out at that limitation.
The cost seg, I guess right now, currently 2025,
Mhm.
without 100% bonus depreciation coming back, which is another
Yeah.
topic for the ages.
Yes.
But what is it at right now if someone wants to do that this year?
So for 25, it's at 40%. So yes, this was a couple years ago when it was still at 100% bonus depreciation.
Yeah.
So yeah, so they were able to deduct all of the amount that was segregated out as the pieces that you could take bonus depreciation on. So yeah, currently as it stands right now, it's 40% for 2025. So if you were to buy a new rental property, do a cost segregation, and say you bought $1 million property, segregated out 15% of that, you had 150,000. You can deduct 40% of that 150,000. So what, $60,000 you can take as an immediate deduction. Now there is talk of bringing back 100% bonus depreciation. That was something that Trump had introduced, and so he wants to bring it back.
Yeah.
If it's retroactively brought back, then we could have 100% bonus this year again. If not, it would probably be part of something of the extension. So maybe something in 2026. That's all speculation at this point. If you're thinking of doing something like this, you want to keep an eye on that and see where that looks like it's heading. That extra 60% of depreciation could make a big difference.
So then here, I got a follow-up case study for you. This is my A-frame property that we're working through. Technically, I guess it's not mine yet because it's new business partnership. I'll send you all that stuff, Derek.
Sure.
Although, again, we haven't done anything in it. So he bought the
Mhm.
property under his name. He took on the
Okay.
loan, all of that. And it
Okay.
is now going to be finished construction next month, sometime next month. So then the goal is to then move that property from him to our joint LLC, if that's you think is the right course of action. As we manage this property together, potentially weighing out if we want to do the STR loophole. What do you
Hmm.
think should be the steps that we should take? Obviously, we don't know if bonus depreciation is back yet. So I don't know
Yeah.
if the 40% makes it worth it to then pay the engineer to come out, because an engineer has to come out or at least do it virtually to itemize everything to give you what that total value that is. What's a tax term for that? Write off?
The portion that's deductible.
Yeah, depreciated. All the things that you can depreciate and bundle that together, and then
Mhm.
you take right now, say if it's 100,000, make numbers easy. If it's
Yeah.
40%, then you have 40K.
Yeah.
Boom, you take that year one, and the rest would be in the following years. If we would do that, what's the ideal steps that we should take next in terms of moving the property, all that stuff, to minimize headache for us all?
Yeah, I guess move it over, but the first thing I guess would be to get the cost segregation study done. You might want to do it after it's transferred into the LLC, and it's going to be based on when you place it in service. So, is it going to be rented out this year?
Yes, ideally, we're up in April for the kids' spring break. We're gonna go out there and enjoy it. Make sure
Test
we
it out.
can break everything.
At that point, you want to do the cost. So you have plenty of time, right? It'll be for the 25 tax return, which won't be due until April of next year. So plenty of time to get the cost segregation done. So you can wait on that until it's put into the LLC. And once you have you probably need to get all the paperwork ready by the time it's up and running. Yeah.
Okay. I do wonder. We want to put in it's a very big an offshoot of Branson Market, which is a very big golf
Mhm.
market. And we do want to put in a mini putting course in the back. I feel like that definitely has a useful life that appreciated. Although I have
Yeah.
no idea how they would evaluate the value of that. I guess
Hmm.
how much you put into construction for it.
If you pay for that separately, then you don't really need a cost segregation for it. It's already segregated out. If you pay for it separately, just have your invoices from whatever contractor you use to build it out.
Gotcha. So like you wouldn't necessarily need that because you could just use that as your
Yeah,
regular
it doesn't need to be segregated out because it's not part of the entire cost of the
structure.
property. So yeah,
That and potentially a pickleball court.
yeah, same thing.
So if you're an Airbnb investor and you're putting in a putting green, a pickleball court, what about a pool? Is a pool more like attached to the house?
Pool does not qualify for the bonus because it has a longer useful life.
But yeah, putting green will definitely need to be refreshed.
So
Okay, sweet. That is what's on the docket for me in March and April.
yeah, and so if you're building things from scratch, you may not necessarily need a if you can get the invoice segregated out by itself, then you have everything separated anyways, and you don't need to have someone come in and study it and figure out how much each thing costs because you have it right there on the invoice. It's
Yeah, because it's a
more
construction loan.
Yeah, it's more when you buy an existing home, right? You don't know what you're paying for the pipes. You don't know what you're paying for the cabinets. You don't know what you're paying for each individual piece of it. You're just paying one big lump sum.
Yeah. No, we
So if
have
you're constructing, if you can get a detailed invoice that has, here's the cabinets, here's the appliance,
mhm.
everything separated out, then you can just lump those together and use those for your bonus depreciation.
That's something I never even thought about, because there is like a $3,000-$4,000 fee to hire the engineer to do all that. And if there's even a way to make that a 20% of the cost
Yeah.
at all, then yeah, for sure. Okay. The next case study you had was, this is the reps, the real estate professional case study. So give me the hook. What did they end up saving?
So this is your traditional, the case that you're looking for when it comes to a real estate professional. You have one spouse that works full-time W-2 job, makes pretty good money, and then the other spouse that works only in the real estate side. And so they can get the 750 hours, they can get more than half because they don't have any other jobs. So that obviously has more than half of their productive time is in the real estate business. And then they have losses on their rental properties. And so they're kind of the perfect storm where you can take all those losses against your W-2 income. These numbers are not going to be as sensational as the one that I just gave you. We're not in the hundreds of thousands. This is one that they have a couple, about $400,000 of W-2 income, and they saved roughly about $30,000 in taxes. So
$30,000 extra.
so yeah, so and it's the situation where if you have multiple rental properties, now you have to follow all the rules, right? You have to truly be a real estate professional. But if you hit that, then you could deduct all the losses on your rental properties. They're not necessarily monetary losses; it could be paper losses because you have a lot of depreciation on these properties. You could potentially do cost segregation studies on any properties that you either have or have purchased. And I think this one, we did do a cost segregation on a property that they had an existing property. So we had to do a change of accounting method form to catch up all the depreciation that they should have taken in the past. And so that created a slightly bigger loss this year, the year that we did the return.
Okay. And so the person who is the partner who is a real estate professional, are they also an agent, or are they just using them managing the property and things as their real estate professional?
Yeah, they also manage some other people's properties as well. All those hours added up to 750, more than 750. There's two tests, right? There's a 750 hour and half of your time rule, which qualifies as a real estate professional, but you also have to materially participate in your properties. Traditionally, you'd have to materially participate, say 500 hours in each property that you have, but you can aggregate them all into one. The IRS allows you to aggregate them into one kind of unit. And so as long as you have material participation in that whole unit of all your properties combined, then it qualifies as a trader business, and you can deduct those losses against your other income, your W-2 business, other things like that. I think sometimes people forget that material participation rule. You could be a real estate agent, get that 750 hours, but if you're not materially participating in your rental properties, you can't take those losses. So you have to make sure that you satisfy both of those requirements.
Okay, fair enough. So I guess if you have a property manager,
Yeah, that whole strategy. Yeah.
for that specific, for those properties that you're trying to do that on.
Yes, correct. Yeah.
Okay. So then the last couple sections I want to do, just important deadlines for individuals, for businesses, corporations. Again, we are filming this in February. What are the things that people need to add on their calendar now so that they don't miss out and that you don't have to bug them?
So the big things are the tax due dates, right? The first one coming up is March 15th. And that's for any pass-through entities. So for a partnership, a multi-member LLC, and an S corporation, those are due on March 15th. If it falls on a weekend, then it's the following Monday, but generally it's March 15th. And then individual tax returns are due on April 15th. Individuals and calendar year C corporations.
Then if businesses are filing for an extension, that needs to be
Yes.
getting by...
Partnerships and trusts, partnerships and S corporations have until September 15th. And then individuals and corporations, C corporations have until October 15th.
Okay. But when do you file for the extension?
You have to file by the due date. So again, March 15th for partnerships, you have to make sure it's filed by that date. Your taxes are due. So the extension is only an extension of time to file, not an extension of time to pay. So you do have to run some numbers and see if you're going to owe. And if you owe, you need to pay with your extension. Otherwise, you get penalized for late payment if you owe too much by the extension time.
Gotcha.
Yeah,
Okay.
so that's one thing that a lot of people kind of miss is they think, oh, an extension, I'll just wait until then to pay. If you owe a lot, you could accrue some significant penalties and interest if you don't pay it by April 15th or March 15th.
Okay, good to know. Any other last dates that people should be aware of?
Just if you're in the Los Angeles area, they did declare it a disaster area. And so anything that's due from the date of the fires forward is the new due date is October 15th. So partnership, S Corp, C Corp, individual payments also are all anything that's due this year is pushed back to October 15th. So your tax due for your 24 return, your first 3 estimates, they're all for 25. Those can all be pushed to October 15th. So it's all of LA County, even if you weren't affected by the fires. Obviously, the people that are affected are going to have a hard time anyways. But if you're in LA County and you weren't affected by the fires, you still have that extended due date.
Last one, blind ranking. Here's how this works. I'm going to give you
Okay.
5 random tax strategies. You don't know what they are. And you have
Okay.
to blind rank them. 1 being, this is the best. I love this one all day long. 5 being, it's good, but obviously not the best. And you don't know what's
Yeah.
coming next. So I'm going to give you 1, and then you're going to have to slot them in 1, 4,
This will
5.
be fun.
And tell me why, too. Ready for the first one?
Okay.
1031 exchange.
I don't know what's next, so I don't know where to put this one. Okay, since I don't know, I'll put it right in the middle. We'll put it at 3. It's a really good because you can obviously defer the tax on the gain indefinitely by exchanging your property for a new property. But again, it's not for everybody. Also, if you don't have a rental property, it doesn't really help you. So I'll put it right in the middle there.
The next one is S Corp versus LLC.
S Corp versus LLC. Okay, I'll put that above because if you have a small business, so maybe I'll put that at 2.
Okay.
Just because I put the other one at 3.
So why do you like it better than just in the grand macro sense of tax strategy? Why did you put that above 1031?
I guess they're both fairly limited. They're probably fairly equal, I would say, maybe a little bit more than the 1031. I've seen it applied a little more, but it can save you a lot of money if you're a small business, depending on how much your income is. It doesn't make sense to just automatically do it. If you're not making a lot of money or losing money, it doesn't make sense. But if you're making any significant money, it can save you a lot in taxes.
Okay. Short-term rental loophole.
I guess, oh man, can I re-rank?
No, you only have 1, 4, and 5 left.
It's a really powerful tool, but is it number 1? I wish I knew what the other 2 were. I guess I'll put it at 4. It might be higher than the other ones,
But you're stuck.
Yeah, I'm stuck, and it's also not for everybody. You can save a ton of money, like we just showed. You also have to be in the right situation too.
Do you assist more people with 1031s or with the short-term rental loophole? Just based off of...
Yeah, probably the 1031s. I guess I'd put that above the short-term rental loophole. Tax impact wise, the short-term rental loophole can be really great, but it is, again, limited. Not everyone can just go out and buy a rental property when they want to. And not everyone has the time to actually actively manage their own short-term rental as well, too.
You didn't want to put it in 1, so you put it in 4. And
So now I got
you
1
have
and
1
5.
and 5 left.
Okay.
Rep status, real estate professional status.
Same thing. Again, it's a super powerful tool, but it's not, again, not for everybody. If you have a W-2 job, I guess I would put that at 5 because it's a very narrow application.
Yeah.
So it has a great tax benefit, especially in California. Both spouses work. It's very hard to qualify for rep status because you can't, unless you work in your real estate properties for more than 2,000 hours, you're not going to qualify.
So that's just 5 by default.
So now what's the last
one? No matter what is number 1. Actually, to me, I think is actually number 1, and that's the tax benefit that you get from selling your primary home.
Actually, I would say that's probably the top one because it applies to so many people. If you're a married couple, you get a $500,000 exclusion on the sale of your home, exclusion from the gain on the sale of your home. So even at 15%, that's what, $75,000 in taxes you would save. Then it applies to most states, but California as well. So you save upwards of 25% on that portion of the gain. Now, if your gain's bigger than that, you're going to pay tax on that. But yeah, I think that's a real powerful one, and it applies to probably the most people. Out of all these strategies, that one applies to probably the most clients than any, probably the other ones combined.
So then you think that is the best way to make $1 million tax-free. You do that twice. You buy a house, you live in it. Ideally, if you live in a fixer-upper house and you fix it up, maybe you get like one of those 2 or 3K loans, which also pays for the renovation costs. Do that for 2 years, flip it. Best case scenario, let's say you make 500K and you're able to, after commissions and all that, have that as profit, roll that into the next one, do that again. You theoretically could then have $1 million in equity tax-free. That seems like the number 1 way every single time then.
If it were that easy, $500,000 in 2 years. But yes, even if you make a couple $100,000, that's a lot of money that you can walk away with tax-free or whatever you can make on it.
So how would you restructure this list now? I'll give them to you again. So blind ranking, you had 1 as selling your primary home and being able to get it 500 grand tax-free. Number 2, you put as the S Corp versus LLC for the small business side. Number 3, you put 1031 just because you just didn't know where to go. 4, you had the STR loophole, and then 5, you had your real estate professional status. How would you change this now?
Yeah, I don't know. It's hard to rank the bottom 4. They're a limited scope. It's not like I would recommend any of those to just everybody. You have to have a rental property to be rep status. You have to
Yeah.
be willing to buy a short-term rental and manage it to use the STR loophole. You have to have a small business for the S corporation. So they're somewhat interchangeable. Maybe I would move up the 1031 exchange just because that applies to a few more people than the other ones. But,
Well, next time I do it, I'll make something that's a little more broad-based nationally.
sure.
Okay, sweet. Well, Derek, this has been
Mhm.
fun. Interesting to get your takes on what could happen this year, and obviously what things people have done currently based off of whatever rules are in place. You're about to get really busy. If you want
Yep.
to get to Derek before he gets extremely busy, I'll leave the link down below to go ahead and connect with him and book a call. If you want to see again, I'll relink the video where we broke down our STR loophole. So that'll be there and you can click
Yep.
that video. But again, if you found any value from this, please make sure to give it a like and subscribe. Derek, any last closing words for the folks who are listening?
Get your stuff to your CPA early. Don't wait until April to get to get him your stuff, him or her your stuff. Yeah, we appreciate it.
Is it easier? Okay, last question on that. Is it easier
Sure.
to then send you things as they come or wait till I have a large majority of it and then send it? How do you like it?
Usually having maybe not a majority, but at least a good portion of your stuff first
Yeah.
so that we can get started. I mean, getting one piece doesn't help me too
Right.
much because I can't really get started.
Yeah.
If you can have like maybe at least half of your documents together and get that, then we can at least get started on it and then work on things as they trickle in. I have clients that do it both ways too. And if they just give it to me one at a time, I just put it in a file and wait until I have enough to get started on it. Sometimes easier if I just get a package of stuff to get started on.
Okay. Fair enough.
Mhm.
Make sure you get Derek or whoever your CPA is, all of your stuff. I will work on my stuff. I promise you will have it soon. I guess I can get it. And again, go click the next video for the
Mhm.
STR loophole and we will see you all there. Thanks, guys.
Great.